Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Tuesday. It's the 15th of November. November is halfway over. We're a few weeks away from December, the last month of the year. Honestly, folks, I remember New Year's Eve last year, spending it with T-Buzz and a couple of friends. It seemed like it was just a month ago, you know? Time just flies. And this year, boy, oh boy, this year we've had a lot of stuff thrown at us. So it's about 8:01 in the morning. The market's going to open up in about an hour and 29 minutes to be specific with you. Now, the market is up really good overnight. I get very, very nervous when the market opens high in a bearish market environment. The reason for that is because typically when markets open up really, really strong, they tend to fade during the day. Similarly, when markets open up really, really weak in a bull market, they tend to rise. So be very, very wary of these numbers because yesterday we opened higher as well, but we didn't close that much higher. So today, in terms of Fed data, we've got the PPI, which I'll talk several times throughout the report, and tomorrow we have retail sales. Now, a lot of the news sources are really focused on the month-over-month number. Excuse me. The month-over-month number really means nothing. I mean, it means nothing. We're looking at year-over-year. We're looking at this number. We're looking at consensus to be at 8.3, lower than the previous number. I don't care if it's 8.4, as long as it's below 8.5. That means the producer's price index could have been peaked out as well. That's what we want to see. And year to year, the previous number was 5.6%. So anything below 5.6%, anything below 8.5 should hold a rally like 8, 8.4. All of these estimates are good because they're all below 8.5. I don't think we're going to get 8.5 because usually CPI and PPI, excuse me, they tend to peak around the same time. So I am expecting this number to be lower, but again, it's very, very hard to say because we're dealing with lagging data. But this number comes out in about 27 minutes, and we'll get a chance to digest it before the numbers do come out. The other pieces of news is we had earnings. We had earnings come out on Home Depot and Walmart. Now, Home Depot was looking at $4.11 on 4.8% year over year. So just to give you an idea of how they did, they topped expectations, but their outlook wasn't really great. So they came out with $4.24 a share. They were expecting $4.11 a share. Revenue came in at 5.6. They were expecting right here. They were expecting 4.8. So they beat their numbers. The numbers are looking good, but their forward-looking statements did not. Now, yesterday, Home Depot. Let's just see here. Yesterday, the stock was down 8 points, and now it's down another 3 points. That's not happiness, and that's a stock that's been really doing very, very well. Walmart, on the other hand, that sneaky Walmart was down yesterday $4, and it's up $9 today, which is very interesting. Now, what'll be really interesting, is to see if this rally holds or if it fades. Now, Walmart was expecting, right here, they were expecting negative 9% and positive 5%. So $1.32 and 100 and up 5% on revenue. So let's see how the number did. So if we look at Walmart, it says Walmart stock jumps after sale and profits, excluding opiate, beat expectations by a wide margin. Shot up 6.6%. Looks like they're doing really well. After net income of $3.11 billion or $1.11 a share, they were expecting. That doesn't look all that. Doesn't look all that great. Maybe I'm missing something here. Let's see. Let's see here. Excluding non-current opiate-adjusted earnings per share were $1.50. Oh, yeah, they definitely beat. And revenue grew 8.7 to 152. Yeah, so it did really, really well. Now, it's interesting. Home Depot did not, but Walmart did. It'll be very interesting to see what the forward-looking statements are from both companies. And again, the biggest thing today, seriously, the biggest thing today would be to watch Walmart to see if it holds on to these losses or if Home Depot, these gains, or if Home Depot holds on to these losers. So Home Depot's down 3 points and Walmart is up 9 points. And again, it'll be very, very interesting to see if this rally holds. I'm very skeptical that the rally will hold after the PPI because the PPI, most of it is already priced into the CPI's positive news. But so far, these retail earnings are not all that bad. That's really, really the key here. They're not nearly as bad. Now, as I mentioned, PPI is going to come out in about 24 minutes. That's going to set the tone for today. Outside of the PPI this week, we've got retail sales, which is going to be really important tomorrow, especially in light of all of these earnings. Then you've got industrial production, and then you've got a lot of housing data. Housing data is not expected to be very positive right now with interest rates higher, so we got to be very, very, very cautious. Now, the bond market, looking at the bond market, it was down yesterday. It's up today. I want to see if the bond market has some more upside. If the bond market has some more upside, that'll be very beneficial for the stock market, because if the bond market goes higher, that relieves or lowers interest rate, which is really, really, really negative for tech and consumer stocks. So I'm looking to see if this rallies. And I'm also looking at the put to call ratio, which yesterday started moving again back to the put side. It was favoring the calls for a while. Now it's backing off, which means the market could be pulling back down. Speaking of market pulling back down, as I mentioned to you guys yesterday, and we were down 2%, not 2%, excuse me, 2 points on the DIA ETF, 0.60 for the Dow. In my opinion, in my humble opinion, it would be very, very difficult, and I mean that, it would be very, very difficult for the broad market to sustain this rally. Keep your eye on the 340 level or 34,000 level. I'm finding it very, very hard to break past that level. And we had a nice little reversal bar yesterday. And typically these reversal bars hold, but again, PPI earnings, the crazy volatility we've been having. So I'm starting to feel that we're going to have a turnaround, and especially with the RSI that cannot, and I repeat, cannot maintain these levels. So from where I'm sitting, it looks like the market is getting ready to cool off. Other things that are giving me similar vibes, as I will show you right now, is the fact that you have all these stocks trading above the 50-day moving average by a huge percentage, but when it comes down to it, S&P still has 48% of stocks trading below the 200-day moving average. The S&P 48, as I mentioned, the Russell 1000, 46. Dow Jones, 40%. Only 40% of stocks are trading above the 200-day moving average in the Dow, and the Dow's trying to it's pretending that it's going to break the 200-day moving average. It's actually kind of laughable. NASDAQ 141%. I mean, look at the momentum levels. Look at the difference between the stocks that are trading above the 50-day moving average. Here. Let's go on a 3-year basis. Look at where we're at right now. On a 50-day, this is the Dow, right? Notice whenever we get close to this red line, we've only gone in the last 3 years 1, 2, 3, 4 times above that line. On a 10-year basis, look at where we're at. And on a 15-year, it doesn't go all the way to 2000, or 98. But look at where we're at from 2006. So it's many, many years. Look at where we're at right now. It would be very, very hard for, and that's the 50-day moving average. Now look at the 20-day moving average. 200-day moving average. Sorry, it's still early here. Look at that. This thing doesn't look like it's ready to break out. Now look at some of the sectors. Look at consumer discretionary. I mean, look at where we're at right now. I don't think this thing is ready to break out. Not even close. Look at basic materials. 100% of stocks are trading above the 50-day moving average. That's the highest level I've seen since this thing's been doing since since COVID recovery. I mean, 100%. But look at how many stocks are trading above the 50-day moving average. Only 46%. So you're seeing a lot of short-term strength, but you're still seeing a lot of long-term weakness. Matter of fact, when I was looking at this yesterday, and I was looking at every stock trading above $2, okay, only 67% are trading above the 50-day, and only 42% are trading above the 200-day. So this thing with the Dow Jones acting like it's running away and it's going to break higher, folks, it's like a rubber band doing this right now. So don't fall into that trap. Do not fall into that trap, especially with the bond market still being in the toilet, and look at individual sectors. Look at where look at consumer discretionary. This thing doesn't look like it's ready to go higher. Technology doesn't look like it's ready to go higher. This is what the Dow looks like, industrial, but that's just a couple of sectors. You've got energy, financial, consumer staples, healthcare. They can't hold up the market without communication services, basic materials, which I think is grossly overbought. Utilities are just kind of trending up. So it's very, 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 very hard to get the entire market to rally when you have that kind of momentum levels and you only have 42% of stocks trading above the 200-day moving average. That's a very bearish market. So the fact that the Dow Jones is trading above the 200-day moving average shouldn't be as big of a deal. Also, you only have 79 stocks trading above the 20-day highs. That's not a high level. Now, it's a lot higher than the 13 that are breaking down, but it's nowhere near enough momentum to really get going. And we were up at a very high level. We were near, look at these levels a few days ago. Just keep your eye on this 79 right here. 490 yesterday, day before yesterday, going into this week, 490, and now only 79. So I do not believe we're going to have a sustainable rally. Momentum levels just do not agree. And with all of this positive news we've been having, I want to remind you of something. Volatility has not really been coming down all that much. It's been kind of just sitting right around here, 25, 24. So be very, 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 very cautious. Now, let's talk about some goodies. Strongest sector, weakest sector. So based on what I'm seeing, energy is still the strongest sector. I would be cautious with industrial right now, and I would be cautious with financial. I still like consumer staples. I still like healthcare a lot. I like utilities, and I like energy. Energy, and more energy. That's right now my strongest sector. And if I was to pick the strongest stock out of the energy sector, it would be a very easy choice because there are so darn many of them. Take your pick. VLO, COM and XOM, always a safe bet. Oxy, one of my favorites. Devon is still right up here. These are the strongest stocks that have been the strongest stocks the entire year. Nothing has changed since January. I'm telling you, if I go back to January, you'll see the same thing. So take your pick, but Oxy's good. US Marathon is good. I like APA a lot. Where's APA right here? It's a natural gas stock. We're having some really cold winter right now coming our way in Germany. So all of these stocks look really, really great right now. And I know I'm singing the same song and dance, but it is what it is. Now to the downside, the weakest sector right now, if we look at the individual sectors, I would say is the consumer discretionary sector. It is. It's definitely the consumer discretionary sector, which is why I'm short so many consumer discretionary stocks. And like Six Flags Magic Mountain, Marriott, Norwegian Cruise Lines, Garmin, you name it, I'm short. But what I wanted to show you was which ones here are the weakest. Let's see. Let's go weakest now. No, I wouldn't do Tesla, Amazon. Actually, let's go to the long list, the long-term list. It's a little more longer term. Here we go. Align Technology right there. Dish, my favorite stock, Dish. No, but seriously, folks, here's a good short list for you. Expedia, Caesars, Seagate, Carnival, Dish, Stanley's Black & Decker. I would avoid this one probably. Align Technology. So you got Align. You got Dish. You got Carnival. Do not buy Carnival right now. Sell Carnival right now. Bath and Body Works. I keep thinking this is Bed Bath & Beyond, but Bath & Body Works. Expedia. Seagate. Take-Two. Disney. Hasbro. I think I gave you a good enough list. Stick with consumer discretionary. Now, before I let you go, I've got something important. Remember, 15 minutes, we've got PPI. In such a market as we're in right now, you really, really, really have to wait for the right opportunity to strike. That's really the smart way to go. High probability entry signals are becoming harder and harder to isolate because markets are very volatile and very choppy. And that's why I went live to show you how I use algorithms to simplify trading, especially when markets are this difficult. We've been able to achieve a real actionable signal, real alert signal rate of 81.48% in the last 5 months of trading with what I'm talking about. It's pretty good stuff. It's really, really good stuff. More specifically, I share 5 patterns that work in a bull market, bear market, choppy market. I explain how they work. I give you the back-tested data. I show you how over the last 10 years, one of these strategies had a win rate of over 93% while holding positions for like 3 days. 10 years. I'm giving them away. It's probably the most action-packed and content-packed class that I've done in many, many years. And these patterns work as well in a bear market, or maybe even better, than they do in a bull market. If you know anybody who's been able to generate a track record of 81.48% with real trade alerts in this crazy Michiganer market over the last 5 months, sign me up. Follow the link below. Do not miss out. You really, really owe it to yourself to check this out. I'm very proud of this, and I think it's got a lot of momentum behind it. So follow now. Click the link below. If you're in YouTube, follow the link below the video, and make sure to comment below the link below. Comment in the YouTube video. I'll talk to you guys later. Have a great, great day. Feel free to reach out to me. Support@marketgeeks.com. I'm always here for you. Bye.